Stock splits are not a new phenomenon and have been used by companies in the past like Apple, Intel, Google and Amazon multiple times before. There are two types of stock split, a regular stock split and a reverse stock split. Firstly, let's look at what a stock split is. Let's make up an example company here. It's the simplest way to explain things. Welcome to Acme Corp. Let's say this company has 10,000 shares worth $1,000 each, which means that the company is worth a total of $10 million because we just multiply the two. Acme Corp wants to do a stock split of 4-to-1. This means for every share they currently have outstanding, they'll create 4 shares in its place, which means that they'll no longer have 10,000 shares, they'll have 40,000 shares. Therefore, if you own one share of the company at $1,000, you will now earn, after the stock split, 4 shares worth $250 each. So you'll still have a total value worth $1,000. In another example, it's the same as having a $100 bill in one pocket and 5 $20 bills in the other pocket. You've still got $100 bills in each pocket. A stock split doesn't change any of the key fundamentals of a company underneath. The revenue stays the same, the profit stays the same, the debts stay the same. Nothing changes apart from the number of shares in issue. A reverse stock split is just the opposite. This would be like Acme Corp taking their $250 shares, splitting them 1-to-4 and going back to $1,000 shares. It's the exact same but the opposite process. So why do companies split their stock? Well, typically companies who've grown really quickly and have a massive share price like to split their stock to enable more investors to get involved in their company. Rather than having to save up $1,000 to invest in Acme Corp, it might be much easier for you to save up $250 to get the same share of the company. When a stock is split, it can appear more affordable to investors who are more likely to invest their money into a certain company. However, this isn't always the case because there are lots of platforms out there now that allow you to trade fractional shares. So you don't even have to buy a full single share of a company, you can buy a quarter, a half, as much as you like. However, most platforms you have to purchase whole shares. So to be honest, until this changes, they can be quite useful. A second reason companies split their stock is to increase what we call liquidity. All that means is by creating more shares, we make it easier for buyers and sellers to get a deal. If there are less shares around and there's lower liquidity, it can sometimes be harder to match up buyers and sellers. Having more liquidity makes it easy to buy and sell. So what kind of companies actually split their stock? Well, they tend to be ones that have grown really quickly, really fast to quite a large share price. Companies who've done really well through a bull market and now want to split their stock. Companies like Apple, Google, Amazon, for example, are no strangers to splitting their stock and have done it multiple times like I mentioned earlier. Remember, it has absolutely nothing to do with the underlying fundamental valuation of the company. All you get is more shares, but the value of the company remains the same. You could argue that when a company does this, they get quite a lot of good publicity, and in fact may even see a rise in their share price because so many news outlets are talking about their share split as a good thing. And lots of people see a lower price and think, I better get in here before this company takes off again. Other than that, a stock split is not a very exciting event. It happens all the time. Keep an eye out in the news, but there's nothing to worry about in terms of losing any value of what you've already put into the company. I hope you found the video useful. If you did, drop me a like, subscribe for more, and let me know if you'd like any other explainer videos like this, and I'll see you in the next one.